How to remove all negative items from your credit report for free. What's in your credit report? Although each credit reporting agency formats and reports this information differently, all credit reports contain basically the same categories of information. Your social security number, date of birth, and employment information are used to identify you. These factors are not used in credit scoring. Updates to this information come from information you supply to lenders. The identifying information: your name, address, social security number, date of birth, and employment information are used to identify you. These factors are not used in credit scoring. Updates to this information come from information you supply to lenders. There's trade lines. These are your credit accounts. Lenders report on each account you have established with them. They report the type of account, the date you opened the account, your credit limit or loan amount, the account balance, and your payment history. Then there's credit inquiries. So when you apply for a loan, you authorize your lender to ask for a copy of your credit report. This is how the inquiries appear on your credit report. The inquiry section contains a list of everyone who accessed your credit report within the last 2 years. The report you see lists both voluntary inquiries spurred by your own request for credit and involuntary inquiries, such as when lenders order your report so as to make a pre-approved offer in the mail. Then you have public record and collection items. Credit reporting agencies also collect public record information from state and county courts and information on overdue debt from collection agencies. Public record information includes bankruptcies, foreclosures, suit wages, attachments, liens, and judgments. What is a FICO score? When you apply for credit, whether for a credit card, a car loan, or a mortgage, lenders want to know what risk they'd be taking when they loan you money. FICO scores are the credit scores most lenders use to determine your credit risk. You have 3 FICO scores, one for each of the credit bureaus: Experian, TransUnion, and Equifax. Each score is based on information the credit bureau keeps on file about you. As this information changes, your credit scores tend to change as well. Your 3 FICO scores affect both how much and what loan terms, which is interest rates, lenders will offer to you at any given time. Taking steps to improve your FICO scores can help you qualify for better rates from lenders. Your 3 FICO scores to be calculated: each of your 3 credit reports must contain at least one account which has been open for at least 6 months. In addition, each report must contain at least one account that has been updated in the past 6 months. This ensures that there's enough information and enough recent information in your report on which to base a FICO score on each report. Credit bureau scores are often called FICO scores because most credit bureau scores used in the U.S. are produced from software developed by Fair, Isaac and Company. FICO scores are provided to lenders by the major credit reporting agencies. FICO scores are the best resource to determine the future credit risk. They are based solely on credit report data. The higher the credit score, the lower the risk. But no score says whether a specific individual will be a good or bad consumer. And while many lenders use FICO scores to help them make lending decisions, each lender has its own strategy, including the level of risk it finds acceptable for a given credit product. There is no single cutoff score used by all lenders, and there are many additional factors that lenders use to determine your actual interest rates. FICO scores range from 300 points to 850 points. A higher FICO score means less credit risk to the lender, which results in a lower interest rate for you. Sometimes a few points can make a big difference. Coming from the mortgage and financial business, I saw it very often. Many lenders require at least 680 FICO score in order to receive a good mortgage rate or car loan. Few points below and you are considered a higher credit risk consumer, which translates into a much higher interest rate. There are many credit data that compose your FICO score. This data can be grouped into 5 categories as outlined below. The percentages in each chart reflect how important each of the categories is in determining your FICO score.